Hello everyone, and welcome back to this series on financial mathematics. Today we're going to be talking about a very important immunization strategy associated to portfolios, which is commonly referred to as cash flow matching. We'll get into immunization in a little bit more detail later on, but the idea of cash flow matching is actually very, very important in order to keep your equity non-negative. So what are these terms that I'm using here? So the idea of equity is usually centered around two commonly used terms, assets and liabilities. Assets are simply items that you own that provide future economic benefits. Some common examples of assets that you might have could be cash, they could be bonds, provided that you are the bond holder, vehicles, for which you have completely paid off and do not own any loans, real estate, assuming that you're collecting rent every single month, and generally speaking, accounts receivable, which is usually a more formal term that is used in the realm of accounting. And then we have liabilities, which are items that you owe other parties, so you owe, not own. Some common examples that you might already know would be loans, for which you have monthly installments every single month. You also have credit cards, because you have to pay that money back, whether it be the minimum balance, and also usually interest if you do not pay your outstanding balance in full. You also have your lease payments. For example, if you do not own your apartment and you have to pay rent every single month. And generally speaking, you have accounts payable. Right, so those are some of the common examples of assets and liabilities. So from assets and liabilities, we can define another term that is usually referred to as equity. So what we're going to do is we're going to define, for example, the total assets. So the total assets is going to be denoted by the sum of our A subscript K, and then we're going to have our total liabilities, which is going to be equal to the sum of our LK. And then from these two terms, we're going to define equity. So definition equity, which will be equal to, let's call it E, and that will be equal to the sum of your assets minus the sum of your liabilities. And generally speaking, we would like this to be significantly greater than 0. All right, so we would like our equity to be as far from 0 on the positive end as possible. Now, generally speaking, most companies and businesses are usually primarily based in assets rather than liabilities, i.e. they usually build their business model around a positive equity, not a negative one. But there is one famous counterexample for this, right? Because I say most companies, so what type of companies and businesses primarily base in liabilities rather than assets? You could consider insurance companies. So how do insurance companies work? Because insurance companies are obviously an extremely large business. There's two common principles you could associate to insurance companies. The first is as follows. They get paid for selling products, you could call them, that do not necessarily exist. And I'll go into detail of what I exactly mean by they don't exist. And again, they are primarily based in liabilities. That is, they kind of make their money from giving money to other people, not assets. And on the surface, that might seem counterintuitive, but let's sort of walk through the basic idea of how insurance companies structure their business model. So first off, we have the customer or the clients, let's say you, and then we have the insurance company over here, whether it be rentals insurance or car insurance. And what you're going to do is you're going to buy a policy, usually a monetary policy, from them. And I won't get into the details of insurance policies because that would be a completely long and disjoint discussion, right? So our customer gives the insurance company, they buy a policy from them. And what does that insurance company do with that money? So they could, for example, invest it into bonds, right? So usually they would get bond coupons because that's good for them. They could also trade stocks with it, right? So they could get stock dividends. So stock dividends. And stock dividends and bond coupons, if you make profit, obviously those two accounts can interchange with each other. But for example, if this is a car insurance company, then when the customer or client gets into a car accident, the insurance company pays them or a third party some money to, for example, repair the car that got damaged, at least in part, or sometimes even in full, depending on what they call the deductible of that insurance policy. Right? So if our accidents, let's say, which some people will call a liability, occur, then the insurance company, IC, then the insurance company gives money to customer. Right? So they make money by giving money back to other people. So obviously they're going to be charging a lot more for people who are highly likely to get into a car accident. So pretty much the policy every single month, the net over some period of time, is greater than or equal to the amount for which they have to reimburse under those particular car accidents. And there's several other nuances that go into that. For example, they only allow you to fix your car with certain companies, so they get a better deal with them. Yeah, a lot of mechanical details that one could discuss there, but we won't get into that here. Right? So that's pretty much the idea. So our liabilities, so we make, this insurance company makes money in some sense hoping that you get a car accident. Even in some states, they require you to have insurance, whether it be car insurance or homeowners insurance or whatnot. And again, there's a lot of political nuances there as well. So generally speaking, what is our goal, regardless of who we are? So our goal is to ensure, to the best of our ability, that our equity is greater than or equal to 0 for all time t, even if our interest rates change, right? Now, how do you make sure that your equity is always greater than or equal to 0 for all time t, even if interest rates change? This can be sometimes very, very difficult, but there are some strategies that you could put in place. So what is some strategies or some basic strategies that one could do? So if our equities is greater than or equal to 0, that means our assets, our total assets, minus our total liabilities, is going to be greater than 0. So that means our assets are bigger than or equal to our liabilities. Where we can clearly see that. So sum of assets is greater than or equal to sum of liabilities. Right? So one strategy that you could do that builds into this cash flow matching is to have or buy bonds that mature, and take a guess when you would like those to mature. They should mature at the same time the liabilities are due. Now sometimes these are predetermined. So sometimes are predetermined. For example, monthly car payments. That's usually predetermined ahead of time, like the 1st of every month, or your rent payment due on the 5th of every month. But sometimes a random variable. Because if you're an insurance company, you don't exactly know when a person is going to get into a car accident, because that literally could happen at any time due to several variables. For example, car insurance, it depends on weather, depends on location, depends on traffic, depends on events, depends on holidays, depends on several different things. So that could be a random variable. And in the case of random variable, usually we have to estimate those times for which those liabilities can have, right? So a lot of probability and statistics that could go into that process, and also an entire field called stochastic processes tries to model those types of processes. So one very important question that we seek to answer is the following. And every time we have this type of structure or strategy, this is usually referred to as cash flow matching, because we're trying to match the redemption of our bonds and the value of the liabilities at those particular times. So that's why we call it cash flow matching. So we're trying to match the negative and the positive to net out to zero or something positive in favor of equity. So the question that I now want to dive into is the following. So how to do cash flow matching if, and this is a big if, we know the times the liabilities are due. So this is definitively applicable to case number 1, and it's also applicable to case number 2, provided that you have already estimated those times of our liabilities. So now let's give a theoretical outline of how cash flow matching is actually executed. So suppose we have two liability payments, L1 and L2, that occur at times t is equal to 1 and t is equal to 2. We're obviously going to be generalizing this from two liability payments to potentially like 5 million, and we're going to have complete control over the values of those liability payments, and we're going to be assuming that they occur at time t is equal to 1 and t is equal to 2. I'm not going to be assigning units here, so this could be 1 month, it could be 1 year, it could be 5/12ths of a year, it could be 7 months, they could be anything. We're going to be generalizing all of these things in just a moment, but we want to sort of get the feel for how we're going to be doing cash flow matching, so we're just going to be assuming this basic structure. So what we're going to do is, if we have two liability payments, we're going to be buying two bonds. The first is going to have maturity at time t is equal to 1, the same as the first liability, and the second is going to be maturing at time t is equal to 2, which is the time of the second liability payment. So what I want to do now is I want to draw two parallel timelines. So we're going to have bond 1, and then we're going to have bond 2. So both are obviously going to start at t is equal to 0. So we're going to buy two bonds, quote unquote, today. And then we're going to be marching through time. So here we had time t is equal to 1 and time t is equal to 2. So bond 1 is going to be maturing at time t is equal to 1, let's assume. So therefore, we're going to have a coupon payment, let's call C1, and we're also going to have a redemption payment of R1, right? So since it matures at time t is equal to 1, bond 1 doesn't really exist after t is equal to 1. Whereas bond 2 matures at time t is equal to 2. So we're going to have a coupon payment of C2 at time t is equal to 1, and a coupon payment of C2 at time t is equal to 2, and also the redemption value at time t is equal to 2, and that's for bond 2, which has a maturity at time 2, the same as the liability, which is due L2. So how many of bond 1s should we buy? Should we buy 5 of bond 1s? Should we buy 10 of bond 1s? 5.2 of bond 1s? Usually we call them shares of company 1 and shares of company 2. So let's phrase this question formally. So how much or how many shares of bond 1, which I'm going to represent by Q1, Q standing for quantity, and bond 2, its quantity is going to be represented by Q2, should we buy at least? I'm going to be framing everything from the equality perspective, so we're going to try and gain at least an equity of 0, but if you can get an equity that's positive, that's obviously very good. So we're just going to figure out the minimum number of shares of each of these bonds that we need to buy in order to, in some sense, break even. So the next thing that we need to do, let's call this step 2, is to consider first the latest maturity bond. So for example, if we have two maturities of N1 and N2, we're going to be considering the one whose maturity time is bigger. In this case, that's going to be 2, since 2 is greater than 1. So how much is due at time t is equal to 2? Well, obviously we are due L2. That's our liability, time t is equal to 2. And we want to figure out, okay, is that going to be equal to C2 plus R2? Probably not, so we need to figure out how many quantities of this payment need to match this particular value. Now, generally speaking, we don't necessarily want it to be equal to. Generally speaking, if you want some profit, you would like that L2 is less than or equal to Q2 times C2 plus R2. Right? That would be something a little bit more ideal, but this value Q2 is the minimum value that you need to do in order to price match or cash flow match at time t is equal to 2. So we can very easily solve this equation for Q2. We're going to get that Q2 will be equal to L2, or liability value, time t is equal to 2, divided by the coupon payment of bond 2 plus the redemption payment of bond 2, where both of those transactions obviously occurs at time t is equal to 2. It's very important to note that this calculation has nothing to do with bond 1, because bond 1 expires at time t is equal to 1, so at time t is equal to 2, bond 1 is not part of that story. That's one of the reasons why we consider first the latest maturity bond, and then we're going to be working backwards in time. So now that we know how much of bond 2 we need to buy in order to price match minimally our liability that's due at time t is equal to 2, there's a couple things that we should specify just for clarity. So we have that Q2 is the number of shares, some people also use the word units, of bond 2 needed to be purchased when at time t is equal to 0 to ensure that two things. One, L2 is matched at time t is equal to 2, and also Q2 times C2 is dispersed at time t is equal to 1. Yes, we didn't directly care about what was going on at time t is equal to 1. Our focus was only matching at time t is equal to 2. But we also have this coupon payment at time t is equal to 1, provided that, of course, you're not working with a 0 coupon bond. If you're working with a 0 coupon bond for bond number 2, then obviously this statement, the second statement, doesn't really make any sense. Right? So we have this money coming in from bond number 2, so we should take that into account when we start to decide how much of bond 1 we need to buy. So we clearly see we have Q2 C2 at time t is equal to 1 from bond number 2. So how much else of B1 minimally do we need to cover our liability L1 at time t is equal to 1, right? So if that is the case, then what do we have? So we need to match. So we need to match L1 minus Q2 times C2. All right, so that's the amount that we need to match. We need to match our liability, but we're already getting Q2, C2 covering at least part of it. Maybe all of it. Who knows if those coupon payments or interest payments are large enough. So, therefore, what's the equation that we need to solve? So we have L1 minus Q2, C2 must be matched to who? It must be matched to the payments that occur at time t is equal to 1, which is going to be equal to our bond 1. So it's going to be equal to C1 plus R1 times the number of quantities of B1 that we actually buy. Right? And keep in mind, this is only associated to bond number 1, and this is obviously associated to bond number 2 or higher, but technically there's nothing else. Right? Right, so that's our liability value to match. right? So what do we know? Well, we know how much is going to be owed at time t is equal to 1. We know how much of bond 2 we owe. We know the coupon payment of bond number 2. We know the coupon payment of bond 1. We know the redemption payment of bond 1. And we just need to figure out what is the number of shares of bond 1 that we need to buy in order to match this. This is a very easy equation to solve. We can see that Q1 will be equal to L1 minus Q2C2 all over C1 plus R1. Right? So that gives us this. So what does this mean? So interpretation of this Q1. So Q1 is the number of units of B1 needed to price match L1 at time t is equal to 0. That needs, not t is equal to 0, but t is equal to 1. That needs to be purchased at t is equal to 0, the same exact time that we bought bond number 1. Right? Obviously, you can buy more to get a little bit more profit, but that is the minimum number of shares that you need to make. So that gives us equations for Q2 and also for Q1, so we actually know how much of each of these bonds that we need to buy. Since we have some general idea of the structure of these calculations, let's actually work through a practical example of how this would be done in practice. So let's assume that you're at a company and you're going to have 3 liability payments. Let's assume after 2 months, after 5 months, after 10 months. So that's going to be our maturity times for the bonds that we need to buy. And those liabilities are of the sizes of 450, 820, and 326, respectively. So since we have 3 different bonds, 3 different liabilities, now we need to buy 3 or more bonds. Sometimes you won't be able to buy 3 bonds that match it perfectly, so you might have to buy multiple bonds to cover one of these liabilities, but technically you can treat them virtually as one bond. That is the combination of some smaller bonds. So since we're going to be buying 3 bonds, generally speaking, then we're going to be having 3 parallel timelines. Right? So let's draw, to our best of our ability, 3 parallel timelines. Right? So that's going to be t is equal to 0, and then we're going to have 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. And then we're going to be having bond 1, bond 2, and bond 3. So what is going to be the cash flow sequence on each of these timelines? So let us just create a bit of notation just to make this a little bit nicer. So let's assume that this is just a coupon payment only. And let's assume star is coupon payment plus our redemption value. So bond 1 is going to have a coupon payment at time t is equal to 1, and then it's going to have a redemption at time t is equal to 2 because that's when our first liability is due. Our next is going to be due at time t is equal to 5, so that's going to be when our next redemption is, and then you can have some coupon payments before it. And then t is equal to 10 is going to be our last maturity time, and then we're going to have some coupon payments before it. And yes, technically speaking, you can have 0 coupon bonds here, but I will mention briefly at the very end of this example why you actually want to have non-0 coupon bonds for each of these, especially if you are an insurance company. So now we have these particular bonds, and it spans over 10, and interest rates could change. So you'd best be getting bonds that do not change in value with our interest rates, right? So you have to sort of hedge against that inflation rates and make sure that these are not volatile bonds or volatile stocks. So then you decide to buy B1, B2, and B3. Such that, so you have this timeline, you're like, okay, I need 3 bonds that at least have these properties, and let's assume that you have the following thing, following 3 bonds. Let's assume that the first one, you pay out $400. The second one, you pay out $526, and the third, you pay out $326. Now, where are you getting this money from? So this could be from the policies that you charge your insurance policyholders, right? So once you have your face values, the amount of money that you lend to whoever, then you're going to have your coupon percentages. So we're going to have R1. Let's assume this is 2.60%. R2, that's going to be 3.21%. And R3, which is going to be 4.112%, which is usually found via, if these are monthly coupons, then that's going to be your nominal annual interest rate divided by 12. And then let's assume that our redemption payments R1, R2, and R3 are given to be $320, so redeemable less than par, $526 redeemable at par, and then let's go $220 redeemable less than par. Right? So these are the three bonds that we have decided to buy. Now we need to figure out how much of each of these bonds we need to buy. So we know which stocks to invest in. How much of each of these stocks do we want to buy? So keep in mind that we multiply each of these. So CK will be equal to RK times FK. That's going to be how you figure out your coupon payments, and I'll leave that calculation to you to figure out. So how are we going to figure out how much of each of these stocks we need to buy? So obviously we're going to start by analyzing the last one because it has a maturity at time t is equal to 10. So let's actually write our maturity times down, N1, N2, and N3. So that's going to be equal to 2, 5, and 10. So we're going to start by analyzing how much of stock number 3 do we need to invest in. So remember, we only have one liability at time t is equal to C, 3. And that's L3 needs to be price matched to Q3 times C3 plus R3. Solving this equation for Q3, you're going to get Q3 is equal to L3 divided by C3 plus R3, generally speaking. And once you plug in all those numbers, you can get approximately 1.3966 shares. Now, in case you're curious, there are some examples in the stock trading world where you can buy fractional shares, especially if it's a bigger company. But if you cannot buy fractional shares, then all you really need to do is just round that up to the nearest integer or round that up to the nearest number of shares for which you do have the ability to buy at. Okay? And obviously, if you cannot buy that many shares, that means you have to, obviously buy less and have to make it up with your other payments in the future. For example, at time t is equal to 5 or t is equal to 2, or you might have to get some supplemental bonds in order to make that up if you can't do it with the coupon payments of the others. Right, so that's going to be how many quantities of bond 3 that we need to buy. So let's just take a moment and interpret this number Q3. So at time t is equal to 10, we will receive Q3 times C3 plus R3, right? And what is that going to be? Well, when you actually do those numbers out, that's going to be equal to 326, which, keep in mind, is the same as L3. That's the entire point of price matching, right? And obviously, this is going to be coming from bond number 3. But that's not the only thing. We also, at time t equals 5, will receive Q3 times C3, which once you do those calculations, you're going to be receiving $18.76. And again, that's also going to be coming from bond 3 only. So once you have that particular object, now we can figure out, okay, how many shares of stock 2 do we need to invest in? Right. So now we match L2 at t is equal to 5, because that's when the next liability is going to be due from us. So how much do we need to price match? Well, if it's a zero coupon bond, then we have to match the entirety of L2, but we are receiving Q3C3 at time t is equal to 5 from bond 3, so we can actually subtract that off from how much money we have left to figure out. Now, please note that I am omitting the coupons that we receive at time t is equal to 6, 7, 8, and 9, and you'll see why in just a moment. So we have to match L2 minus Q3 C3, and that's going to be equal to what? So that's going to be equal to Q2 times C2 plus R2, where this is obviously going to be the payment that's going to be coming from bond number 2. And all we really need to do is figure out, okay, what is the quantity of bond number 2 that I need to figure out in order to price match at time t is equal to 5, the value of L2, minus the value that I'm getting from bond 3. So I already know the liability at time t is equal to 2. I already know Q3. I already know C3. I already know C2. And I already know R2. Those are the things I bought and agreed to. I'm just trying to figure out what my quantity of bond 2 is going to be. So once I solve for Q2, I'm going to have Q2 is equal to L2 minus Q3 minus C3, not minus, but times C3, all over C2 plus R2. And obviously you should be seeing, is there a pattern to these formulas? Once I have like 50 million stocks, the obvious answer is going to be yes. But once you plug in these numbers, you're going to have approximately 1.4759 shares of stock number 2, or bond number 2. Right? So let's just analyze this particular number. So at time t is equal to 5, we will get what? So we're going to be getting Q2 times C2 plus R2. This is going to be coming from bond number 2. And we're also going to be getting Q3 times C3. And this is going to be coming from bond number 3. So once you do these calculations, this is going to come out to approximately $801.24. And this is going to be, again, $18.76. And take a guess of what you get when you add these numbers. You're going to get $820, which, in case you don't remember, is the size of liability L2. Right? So we have matched that liability, but of course you can buy more of bond 2 and bond 3 to get more money than L2. That would obviously be profit, but at least we have price matched and quote unquote immunized our portfolio against this particular liability. Right? So similarly, take a guess of what the equation is that we're going to be building Q1 from. So we need to price match L1, but we're getting some money from bond 2, and we're also getting some money from bond 3, potentially. Obviously, if it's zero coupon bond, then each of these are going to be 0, and then it's going to simplify immensely. And that's going to be equal to Q1 times C1 plus R1. So that's the coupon and redemption of bond number 1, which is the bond that matures the earliest across all 3 bonds in our portfolio. So what do I know? I know L1. That's already predetermined. Q2, C2, Q3, C3 I've already determined. And C1, R1, that's what I negotiated in my bonds of choice. Now I just need to figure out how much of bond 1 do I need to buy. That's obviously going to be Q1. So isolating this equation for Q1, that's going to give you Q1 is equal to left-hand side, and I'm going to factor out a negative sign out of these right two. So I'm going to have L1 minus Q2 C2 plus Q3 C3. Then that's all going to be divided by C1 plus R1. So that's going to be the equation for R1. And once you do out all those calculations for our example, that's going to be approximately 1.2298. And you can verify that under the transactions that occur at time t is equal to 2 across bonds 1, 2, and 3, you will match the value of the liability at time t is equal to 2. Right, so everything is immunized with respect to our liabilities, so everything is great. Now let's just make a couple notes here to sort of close off this discussion, since now we have cash flow matched our portfolio, or we have immunized our portfolio of liabilities with respect to cash flow matching. So the coupons at times t is equal to 1, 3, 4, 6, 7, 8, and 9. Which, keep in mind, is the set of all numbers from 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10, except for 2, 5, and 10, which are the maturity dates N1, N2, and N3 for our liabilities. We didn't do anything with those coupons in these calculations, so what exactly are these coupons going to be equal to? These are all equal to profit. So that should make you happy, right? So at least you're making money on top of not having to really pay for your liabilities, because your bonds are actually paying for your liabilities, and you're getting this passive revenue stream from your coupons, which is actually pretty great. Right, so that's pretty much how insurance companies, one of the many ways that insurance companies make money. So what about the formulas for cash flow matching? Is there a general equation for example, Q1, Q2, Q3, Q5 million? The answer also is yes. So let's assume that you have your liabilities occurring at N1, N2, N3, all the way down to little n subscript capital M. So you have liabilities of L1 here, L2 here, L3 here, all the way down to L capital N here. Right, so that's how much you have to pay, which means you have to buy, not that buy, the different other buy. So we need to buy capital N bonds with maturities at N1, N2, down to NM. So once you have those bonds, so each of them are going to have their associated face values, their associated redemption values, their associated coupon rates, and from those coupon rates and those face values, you can also get your coupon payments from those. And then the very first bond that you're going to analyze is the last one that occurs at time t is equal to capital M. So what is that quantity going to be worth? So that's going to be Qn is going to be equal to Ln, that liability at time t is equal to capital M, divided by C capital M plus R capital N. So that's the quantity of your last bond that matures. And more generally, Qk will be equal to Lk minus the sum from j is equal to k plus 1 all the way up to capital N of Qj Cj, all divided by Ck plus Rk. And this is for k is equal to 1, 2, down to capital N minus 1. Right? So that's the quantities for the other ones. So that gives you an algorithm that you can easily code in whatever coding language you know that can easily do all those calculations for you very swiftly. So that's one of the ways that you can immunize your portfolio and guarantee to some degree that your equity is always greater than or equal to 0, provided, 1, that the interest rates do not change, and 2, that your liabilities do occur at predetermined times, N1, N2, N3, and so on, and that you also know all these values, and you don't have any very strange things where, for example, the people that you bought the bonds from call early, or you decide to put early as well, because that can always throw things off. So I hope you enjoyed this video, and I'll see you in the next one. Take care.